Hello everyone and welcome back. So in a previous video I talked about the need to open a bank account, and one of the reasons I said is because they pay interest, which is not one of the big reasons, but it's definitely a perk that when you open a bank account they will pay you interest just for putting your money in there, meaning don't put your money under a mattress. Well, don't put too much, but put what you can in a bank, especially because it's insured, meaning if something happens to the bank, you will get the money back up to $250K at this moment. But anyway, one of the perks of putting your money in a bank account is you get paid interest. So for example, if a bank pays 1%, which is really high, I have not found any bank that pays 1% yet. So if you find one, please let me know. But just for example purposes, let's say a bank pays 1%. And you deposit $100 in. They will pay you 1% times 100, which is $1. So then at the end of the year, instead of 100, you'll have $101, and then the next year, it'll keep paying you 1% on that 101, and then it'll keep snowballing, right? And so that's just for example purposes. The more money you put in, the more interest you're going to get. But my point is, you're not going to make a lot of money just from bank interest, putting your money there by itself. That's not how the rich get rich. But, that might be something you want to consider when you're choosing between banks. For example, a bank that pays 0.01 versus a bank that might pay 0.4, right? So that's for you to decide. But my point in talking about this today is, how do banks make their money, right? Like, why can I put my money in there and they can pay me back the interest, right? Like, free money. How are they not losing money? So I figured I would explain it in a video. So the reason that they are willing to pay you interest just for putting your money there is because they're making so much more money off of you putting your money there. It's crazy. They're using your money to make money. It's great. It's a great business model. So anyway, how banks make money, there are three main ways. The first way is what I'm going to be talking about today. The second way is interchange fees, where you swipe your credit card, swipe your debit card, and they take fees on that. And the third way is just the many exorbitant fees that banks charge, like ATM fees, overdraft, late payment, blah, 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 foreign transaction, all of those fees. They also make money off of that. So try your hardest to find a bank that doesn't have a lot of fees and to avoid those fees if possible. And sometimes you can even ask your way out of those. But that's a thing for another time. The one that I want to talk about today is about the one that really pertains to us in terms of the interest rate. So how banks actually make their money and why they're happy to pay you an interest rate of 0.01 or 0.6% that you're like, woo, free money for just sitting there, right? The reason is, what happens is, when you put your money in the bank will take your money and give it to somebody else in the form of a loan, right? So when you're looking to buy a house or buy a car, where do you go? Most people, or often people, will go to a bank and get some kind of a bank loan or a mortgage loan from a bank, right, to buy a house or whatever. So where does the bank get that money? From you. So when you're putting your money in, the bank will take your money and lend it to somebody else. Let's say you're like, oh, but I only put $1,000 in, I don't have enough. What they'll do is they'll take $1,000 from several people, pool it, and give it to somebody, right? And then another question you might ask is, well, if they take my $1,000, I only have $1,000 in there, how do I get my money out, right? Great question. What do they do? And this is the problem when people go for a bank run, which is when people go and all try to get their money out at the same time. That's when the bank goes bankrupt, because they've lended the money out. They physically don't have the money to give you your money, which is your money that you've put in there. They can't give it to you because they've lended it out, right? So in the case of a not bank run, in normal times, even though they've lended your money out, money is just money at the end of the day. So when I say, let's say, I've deposited $1,000 and I want $500 back out of it, and they've already given out my $1,000, they'll take the $500 from somebody else's account and give it to me, right? And so that's how it works. It's just moving money around. The numbers still show up correctly, and when they need to give money to you because you need to withdraw money, they'll just move it from somebody else's account. And because not everybody's taking money out at the same time, they can afford to do that, right? So back to, how do they make money? Well, when you put money in, let's say I'm really rich, right, and I put $1 million in. Let's say somebody wants to buy a house for $500,000. Mortgages are really low right now. It's like 2-ish%, so that's really low, but sometimes it can go really high, you know, like 5%, maybe 10%, but they're at lows right now at 2%, but typically they've been higher. So this is like an all-time low at 2%, okay? How much are they paying you in interest? Max, the highest I've seen is 0.6%. So how do they make their money? They take the $500,000 that you've put in, they give you 0.6%, and then they give it out for, let's just round it down to 2%, right? Let's just make it really low. They give it to somebody else, they want to buy a house, the bank lends $500,000 to somebody else at 2% interest. So they're earning 2% interest with your money that you've put in, and they're only giving you 0.6%, which means there's a discrepancy of 1.4%. And what is that? That is the bank's profit. That's how much they're making off of you putting money in that bank account. So you're like, oh, it's so great, you know, I can put my money in there and it just sits there and I can collect interest at the end of every month. Isn't that great? Yes, it is great, but the bank makes so much more money than you do, which is why they encourage you to put more and more money. This is why they have those rewards programs where the more money you put into their bank, the better the interest rate they give you, or the more perks they give you, because they want you to put more money in there so they have more money to lend out to other people to gain that higher interest rate. They'll pay you, you know, a little bit of it, and they get to keep that huge chunk. So they're basically earning money using your money. Obviously, you know, like I said, they have the other fees that they earn money with, but this is a huge part of how banks make money, and so hopefully this clears up, you know, why banks pay for you to just have your money sit there. All right, so hopefully that was helpful, entertaining, informative. As always, leave comments, suggestions, feedback, questions, and stay tuned for next time. Thanks.